And we did that before, and you would have done that with Sam in Introduction to Bookkeeping Transactions. So you've had exposure to those types of accounts, but we're really going to understand them tonight and apply some logic and knowledge to them. We're going to have a look at what the VAT control account does. And again, you'd have touched on that. You'd have certainly posted some double entry to that in terms of your first unit. But we're really going to explore that tonight and delve a little bit deeper. And finally, we're going to do some calculations and some double entry for the wages and salaries control account. So a real theme really to tonight's lesson. It's all around those control accounts. Okay. So we're going to kick off, and we're just going to have a bit of a revision from the first module. So in the first module, you would have come across 3 ledgers. So guys, it's not a test. It doesn't matter if you don't know. But what do you think those 3 ledgers are? Lovely. I can see there's some people still typing, so I will just wait. Okay, perfect. Okay, so we've definitely got knowledge there from our first unit. So the names of the 3 ledgers that we're predominantly interested in are the general ledger, and sometimes you may have heard that referred to as the main or even the nominal ledger, the receivables ledger and the payables ledger. And those are the ledgers that we're going to focus on this evening, and we're going to look at the relationship between them. But those are ledgers that you would have come across in your previous studies in that first module. I like to think about the ledgers as kind of a pyramid diagram. So the general ledger for me is that all-encompassing ledger. That's the ledger that captures all the T accounts, all the ledger accounts, and that feed the trial balance. And again, that's a term that we should have come across previously. The general ledger holds all the accounts of the business, such as its sales, its purchases, returns account, asset accounts. And the sitting below the general ledger, we have the memorandum ledgers. We have the receivables ledger and the payables ledger. And they kind of do what they say on the tin. The receivables ledger captures all the accounts of my credit customers, my receivables. The payables ledger captures all the accounts of my credit suppliers, my payables. It's only the accounts in the general ledger that feed the trial balance. So if what I say is true, surely I'm a chunk of data missing, because surely I'm missing the information for my receivables and my payables ledger. Well, I absolutely would be if it wasn't for those control accounts, receivables and the payables ledger control account. And they sit and are recognised in the general ledger, and they summarise all the information from the receivables ledger and the payables ledger. Okay, so I have one figure that represents my receivables balance, and I have one figure that represents my payables balance. And those control accounts sit in the general ledger and will form part of my trial balance. I suppose a really valid question is, why do we divide the ledgers? Why is the ledger split into 3? Well, if you think about, yeah, of course, no problem at all. If you think about the division of the ledgers are split to organise transactions. So if you think about any business that you're concerned with, and that could be a business that you're employed by, that could be a business that you do your weekly shop by, that could be a business that you shop with regularly. So it could be any business. Think of the volume of transactions that occurs in that business, from sales to purchases to returns. What about when they buy non-current assets? What about when they pay their staff? What about when they pay their electricity, their rent, their rates. What I'm trying to capture there is the volume of transactions that a business processes. And what we're trying to do here is we're trying to organise the ledgers to almost mirror the functions of the business. So in my receivables ledger, I have all the accounts of my credit customers, my receivables. And if as a business, I have 100 receivables, then I'll have 100 ledger accounts in that receivables ledger. Each customer has their own ledger account, so at any point in time, I can see what customer owes me what and when that is due. For your business, for a company you work for, that ledger is probably looked after by a function called credit control, accounts receivable, or even a sales ledger team. The idea of the receivables ledger is to make sure that at any point in time, you as a business know what customer owes you what. The flip of that is the payables ledger. So the payables ledger captures all the accounts of my credit suppliers, my payables. So at any point in time, I know what supplier I owe what to. And again, within my business, that's probably going to be looked after by a purchase ledger team or an accounts payable department. And they're responsible for making sure timely payments are made to my suppliers. But if you're not a credit customer, and if you're not a credit supplier, then your account exists in the general ledger. So the general ledger is that all-encompassing account that captures all the other accounts, all the other ledgers. My assets, current and non. So motor vehicles, computer equipment, inventory, cash and bank balances. My liabilities, so maybe I owe HMRC, and we'll talk about that later on during the session tonight. Maybe I'm overdrawn, maybe I have a liability to the bank. It captures my capital transactions. So again, it looks at what I've invested, what the owner of the business has invested in this business. It captures my expense accounts, my electricity, my wages, my rent, my rates. It captures my purchases, my income. It captures everything that is not a customer or a supplier account. The control accounts sit in the general ledger, and the control accounts are those total accounts which summarise the memorandum ledgers. The receivables ledger control account contains one figure, gives me one figure that gives me an overall asset value. And I'm saying it's an asset value because my customers owe me money, and the money that I'm due is an asset to my business. It's a current asset. So my receivables ledger control account provides one figure to me. And as the manager of this business, that's what I'd be concerned with. As a manager of the business, I wouldn't necessarily be too concerned with the individual balances because I've got a credit control team, an accounts receivable team that are looking after that for me. But as the manager, I'd want to know exactly what is the figure that I'm owed by my customers. Equally, for a payables ledger control account, I'd also want to know what my total exposure is. What's my liability? One figure that represents the total value that I owe my suppliers, that I owe my payables. And these control accounts is going to be the focus of the work that we do initially this evening. And these control accounts are recognised in the general ledger, and the general ledger will take those control accounts forward into trial balance. Now, you'd have come across the receivables and the payables ledger control account in your first unit. You'd have certainly made transactions into those accounts. You'd have done double entry. In this module, it's assessed in just a very slightly different way, and we're going to look at that this evening. Before I move on, guys, are there any questions? Are you all okay with that? Perfect. That's great. Thank you ever so much. Okay. So What I'm about to share with you guys is nothing new, but it's just a list. And sometimes that can overwhelm us because we instantly think, I've got to learn this. And that's not the message from me this evening. You're far better understanding what this account is trying to show. Because if you understand it, then no matter what's thrown at you come exam day, you'll be able to apply your knowledge to it. So the receivables ledger control account captures all the transactions of my credit customers and gives me one figure that represents what they owe me at the end of the period. And that's what I'm concerned with. I said previously that this account is an asset account, and therefore anything on the debit side of the account will increase the asset. Anything on the credit side will reduce it. So thinking about those types of transactions, so the balance brought down on the receivables ledger control account will always be a debit, because collectively, our customers will always be an asset balance, collectively together. That's not to say in the memorandum account ledger, the receivables ledger, you may not have a customer account that's a credit balance if there's been an overpayment. But as a total, in the control account, the balance brought down is always a debit. The next item I've got there is credit sales. And the key word there, guys, is credit. So if you ever come across a cash transaction in one of your questions when asked to prepare a control account, that really needs to be disregarded. So if I sell more to my customers on credit, they're going to owe me more. That will increase the asset. It's on the debit side. The dishonoured check, it's just another way of saying a bounce check. So if a customer pays me, it's presented to the bank, it doesn't clear for whatever reason, I'm going to debit the receivables ledger control account to restate the debt and to ensure that hopefully I pursue funds in another way. The credit transactions will reduce what your customers owe you. So when your customer pays you, those receipts from your customers, they'll reduce the asset and recorded on the credit side. If I offer my customers prompt payment discount and they take advantage of it, that will reduce what my customers owe me, and that's what we call discount allowed. And again, a term that you should be familiar with from introduction to bookkeeping. If I've sold damaged or inferior goods, I've overcharged my customers, I'll issue them a credit note, and that credit note will form part of the sales returns daybook. Those sales returns will reduce what my customers owe me and on the credit side of the account. And a contra entry, and this is probably a new term for this unit, but a contra entry is where we do a book entry. So this is where we supply and we buy from the same company. So instead of them paying us and us paying them, we just agree to do a book entry in their customer and supplier account. So this is sitting on the credit side of the receivables ledger control account to reduce the asset. And later in the session, when we do the payables ledger control account, you'll see it on the debit side, because the debit side is going to reduce the liability. So a contra entry, it's a new term for this unit, but it's an entry where there is a bookkeeping entry only. There's no monetary movements of funds. We don't pay our customers, and equally a supplier, and they don't pay us. But we do a bookkeeping entry to negate the balances. And maybe that dishonoured check, maybe if we can't recover it in another way, maybe that ultimately becomes irrecoverable. That's an expense to my business and ultimately will reduce what my customers owe me and sits on the credit side of the account. I'm hoping that makes some sense, and I'm hoping that's quite familiar in terms of what you've done previously. But if you're quite new to your studies, it takes a while to embed the knowledge. So guys, if you are new and you're not totally comfortable with that receivables ledger control account at the moment, then I'm just going to pause for a moment and allow you to take a quick picture on your phone if you'd like to. You will be presented with all this information following the session, but we're going to do a couple of activities and you may benefit from having that sight of that. So I'm just going to pause and allow that you to take a picture if you wish. Okay. Okay. So We work as an accounts assistant, and we've been asked to verify the balance owed by our receivables for an upcoming meeting. We've got the following information, and we like it because it's presented nicely to us. It's in a table. We like tables. We're comfortable with that layout. I'm just going to go through the headline figures before I ask you to do a few calculations for me. So goods sold on credit, and that excludes VAT, of £150,000. It's important to remember, guys, that the figures that our customers owe us include VAT. They owe us for the goods, they owe us for the VAT, and therefore that's a little bit of a red herring, because in terms of this transaction, it's not 150,000 that's going to be included in this figure. It's the grossed up value. So it's 180,000 our credit sales are represented. And sometimes questions will throw, I suppose, little curveballs in just to make you think, just to make you really test yourself. The figures in the control accounts should always include VAT. If you're not told anything about VAT, then you assume the figures are already inclusive, and therefore you don't need to do anything. But I just wanted to demonstrate that's just, an easy little thing that you could potentially lose some marks over. So if I sell goods to my customers, that's going to increase my asset, debit side. Money's received from receivables. So my customers have paid me. They no longer owe me. I'm going to have debited the bank. I'm going to credit my receivables ledger control account. I've obviously offered my customers prompt payment discount, and that prompt payment discount reduces what my customers owe me. So I'm going to credit that through the receivables ledger control account. I've obviously sold some damaged goods, or my customers clearly aren't going to pay me for those, guys. So I need to reduce my receivables ledger control account by crediting it. And finally, I'm told that a debt which is due from A. Jones has been deemed irrecoverable. So I'm clearly not going to recover those funds. So I need to reduce my receivables ledger control account by that £350. And I'll do that by crediting the account. And I'm told, guys, that at the start of the month, the receivables owed the business a total of £180,000, 824 pence. So, guys, what I would like you to do, and I'm going to give you a couple of minutes to do this, and please don't panic. It's not a test. It doesn't matter if we don't quite get there. But I would like you just to jot down what you think the receivables ledger control account should look like. And I would like you to calculate ultimately the balance carried down on this account. Before you do put it back in the chat, just pause and I'll tell you when I want you to post the answers. So don't post your answers immediately. Just pause for a second. Once you've got that figure, just pause and I'll tell you when to post them. And if you've got any questions, please shout up. So just think as you're going through those transactions, what impact does this have on my balance? Does it increase what the customer owes me? Does it reduce? If it increases, what we saw before, it will be on the debit side. If it reduces, it will appear on the credit side. And then balance that account off for me. I'll just give you a moment longer, guys. Okay, so if you've got a figure, and please don't worry if you haven't, but if you've got a figure, Pop it in the chat now for me, guys. Well done, Jenny. Excellent. Okay. So what we need to do is we need to see if we agree with Jenny. Let's have a look what that control account looks like. Well, those are the transactions mapped in. Everything on the debit side will increase. And remember, the credit sales that we saw previously were 150,000, but we know they have to include VAT, so they become 180,000. Items on the credit side reduce, which means at the end of the period, the balance carried down absolutely is 163,310. So that's fabulous. Well done. Guys, if you didn't get that number, that's okay. The whole point of these sessions is to be informative. But just take a note of that number because we're going to look at it in a slightly different way now. So really what we've done there is we've pulled on our knowledge from our first unit. We knew that this was an asset account. We knew that it tells us the total value of what my credit customers, my receivables owe me. But in this module, it's assessed in a slightly different way. So £163,310, just be mindful of that figure going forward. That's the balance in my general ledger on my control account. In my memorandum account balances, in the receivables ledger, I have 7 customers. So the first question I have for you is, what's the collective balance on those receivables ledgers? And guys, it's nothing more complicated than just adding the 7 figures together. And when you've got that figure, please feel free to pop it in the chat. So add those 7 amounts up for me. Tell me what you've got, guys. Perfect. Yeah, well done. Excellent. That's great, guys. It is indeed the figure. But if my memory serves me right, that is different from the control account balance. And that's where this module is different, because what we now need to understand is why. Is there a difference between the control account and the ledger account balances in the receivables ledger? Because remember, the control account is just summarising all the lower ledger activity. So in this unit, you're going to be asked to prepare a reconciliation between the balance on the receivables ledger control account and the balance on the receivables ledger. And you're going to be asked to work out what the difference is. And we can clearly see it's not a lot, but it is £350. And we need to investigate that. We need to understand why and take the appropriate action. Well, actually, this is quite nice, because instantly we have 2 figures that are going to point us in the right direction. Our difference is £350. And if we look at the receivables ledger, we have an account for Brandon Limited, a customer who owes me that figure. So has that invoice been missed from my receivables ledger control account? Well, it could be. And if that was the case, then the receivables ledger control account would increase and my difference would disappear. Guys, I'm just going to flick back a slide now. So apologies about flicking through backwards and forwards, but I just want to bring your attention to that irrecoverable debt. That's also for the amount of £350. So it could be that. It could very well be that that irrecoverable debt has been written off in the receivables ledger control account, but it hasn't been written off in the receivables ledger. And if it was, well, then the receivables ledger would reduce, my difference would go. And it's nice and easy when we can relate a figure to it. We can see that there was potentially 2 offending items there. If we were doing this as a job, where would we start? Well, I'm not going to lie and say it's not quite a tedious task, guys, because it can be. but you're going to look back at your day books in the first instance. You would look back at your day book totals and make sure they'd been transferred into the ledgers appropriately. If they had, then it's taking it a step further back and looking at the source documents, going back to your invoices, going back to your credit notes. Did all the transactions take place as they should? It can be quite a tedious process, but of course in the exam, we're not going to have the luxury of having that amount of knowledge and information at our disposal. In the exam, I would suggest it probably won't be quite that straightforward, as you would probably guess and appreciate. So let's now have a look at what happens when it's not quite straightforward, and we're going to utilise that example to have a look at the payables ledger control account. Before I do move on to the payables ledger control account, are there any questions? Are you all okay? Perfect. Okay, excellent. Okay, so let's look at that payables ledger control account now. So some familiar terms here, it's just everything's flipped. And this is a liability. This represents the total value that I owe my credit suppliers, my payables. So as you would expect, items on the credit side increase the liability, items on the debit side reduce. That balance brought down, I can confidently say, will always be a credit on the control account. It will always show the total that you owe your suppliers, your payables. And if I make more purchases from them during the month, credit purchases that is, I'm going to owe them more, the liability will increase. If I make a payment to my suppliers, then that will decrease the liability, that will reduce what I owe, and consequently will sit on the debit side of the account. And if my credit suppliers offer me prompt payment discount and I take advantage of it, that will reduce what I owe. And that's what we call discount received. And maybe I've purchased goods, they were faulty, they were inferior quality. Maybe when I've received my invoice, they've overcharged me. If I'm due a credit note from my supplier, that's a purchase return and will reduce what I owe, and it's on the debit side. And there's that new term again, that contra entry. So if we remember rightly, on the receivables ledger control account, it was presented as a credit because it reduced the asset. And the payables ledger control account, it's a debit to reduce the liability. Your double entry is complete. There is no monetary movement of funds here, guys. We're literally just doing a book entry to reduce the liability in the payables ledger control account, reduce the asset of what our customer owes us in the receivables ledger control account. So that's a book entry. And then, of course, the balance carried down. And again, guys, if you're not totally comfortable with the payables ledger control account at the moment, that's okay. And that's the whole point of these sessions. But we are going to do something a little similar to what we did previously. So I will pause and give you the opportunity if you wanted to take a quick picture of that slide before we move on. I would also stress, guys, that, the message from this is not to go away and learn these lists. It's to understand what the control account is trying to achieve, because if we do that, the transactions will just naturally fall into place. Okay, let's have a look at a question. So we work as an accounts assistant, a similar theme to before here, and we have the responsibility for the payables ledger control account in the general ledger. We've been provided with the following information for the month of January, and we're asked to calculate the amount owing to our payables at the end of the month. Okay, so again, let me talk you through the headline figures on this, and then I'll give you a moment to calculate the figure. Owing to suppliers at the end of January is 114,275. Well, if it was owing at the end of December, guys, it must mean that it's owing at the start of January, and consequently, that's our balance brought down. Okay, it's what we owe, it's a liability, it will be a credit. Credit purchases for the month of January. So if I purchase more from my suppliers, I'm going to owe them more. That will increase the liability. It's a credit. But this time around, there's no mention of that. So I can assume that that's a VAT inclusive figure. Cash purchases for the month of January. Well, cash transactions, as I said at the start of this session, don't impact the control accounts, guys. And consequently, that's a bit naughty. That's a red herring. But that's something that could present itself in the exam. So cash sales, cash purchases, they have a place in our records and they will be accounted for, but not in terms of the control account. So we're going to ignore that one. And the payments are made to suppliers throughout the month. That's going to reduce the liability. So we're going to pop that on the debit side of the account. Okay, I'm going to pop that on the debit side of the account to reduce the liability. Goods returned to suppliers during January. We've obviously had purchase returns, credit notes issued to us. That will also reduce the liability. So you can kind of guess what's coming next. I'm going to ask you to prepare a payables ledger control account for me. And I'll just wait to see what that one comment is, guys. This is where I get confused. Michelle, can you elaborate on that at all, please? Okay. Yeah. Okay. So, okay. Yeah, absolutely. Okay. So I see your point. So Pearls is a really effective tool that we use to help you embed your knowledge of double entry. And you know that your purchases, your expenses, your assets on the debit side. But the purchase represents the value of the goods that you've bought. So yes, we absolutely would debit purchases, but we debit purchases with the value of the goods. What we owe our suppliers and what we're trying to capture here is the ultimate liability we have to our suppliers. So consequently, we credit the payables ledger control account with the goods plus the VAT, because the goods plus the VAT is the liability we have. So when we do our double entry, remember our double entry is almost like a set of weighing scales, and the weighing scales have to agree. The debits and the credits must agree. We debit purchases to recognise the value of the goods we've purchased with the intention of selling them on at a profit. We debit the VAT account because that VAT is reclaimable. And we credit the payables ledger control account to capture the liability we have to that supplier. And that's, I can completely see your point, completely see it. And when you're new to it, yeah, it's absolutely, there's debits and credits, there's the purchases, there's payables. What does it all mean? But it will click. And I know it sounds a bit of a cliche, but practice really does make perfect. There's some excellent resources available, on your platform. And of course, if you need any further clarification following this session, Michelle, I'll gladly, do what I can to help. I think we should just pop something in the chat as well. So I hope that helped a little bit. But guys, for now, if I can ask you just to try and work out what you think the balance carried down is on this account. Okay, and when you've got the figure, guys, please feel free to post it. Okay, and don't worry, it's not a test. If we don't get it quite right, that's absolutely fine. So try and think about this account in terms of what does the transaction do? Does it mean I owe my supplier more? Does it mean I owe them less? Because that will really help with the placement. And if you're brave enough, guys, when you've got the figure, pop it in. Perfect. We've got a common theme here, guys, which is great. So 31,293. That certainly sounds familiar. So let's have a look. So we've got our balance brought down and our purchases on the credit side. They're going to increase what I owe my supplier, and the items that reduce on the debit side. And remember, there's no place for that cash transaction. That was a bit of a red herring. It was a bit of a naughty question to ask. Okay. So the balance carried down absolutely is 31,293. So well done, guys. Now, for the purpose of this exam, that's all you're going to have to do. And then we're going to do a reconciliation. But what we're trying to train you to do, guys, is, yes, of course, get you through the exams, but also to go and do this job in the real world. And the one thing, if this was my business, if I was the manager of this business, the one thing that I would be interested in is looking at the relationship between my starting and my ending position, because there should be some commonality there. There should be a trend. And that's probably something I'd want to understand a little bit more in terms of this example, because at the start of the period, I owed my suppliers $114,275. Yet at the end, I owed them $31,293. And that's a dramatic reduction. So not in terms of this exam, that's not something you would have to concern yourself in terms of the exam. In terms of the exam, you get your figures, you place your figures, you calculate the balance carried down. But if you were a manager of this business, you would want to understand that value. You'd want to understand that movement. It could be absolutely fine. It could be there's an error in there. It could be we've made an exceptionally large payment during the period. It could be our purchases are significantly lower than prior periods. But it's just from the manager's point of view, understanding what these balances mean. And that's where we're ultimately getting you to go, understanding what these accounts mean. For now, let's just make a note of that £31,293 because we need to look at that again. So jot that down for me, 31,293. That's the figure that we need to come back to, hopefully. So very similar to before, the balances in the payables ledger. I've got 6 suppliers, 6 payables. Guys, what do they add up to? Pop it in the chat when you've got that figure. You're absolutely right, guys. And that's a bit of bad news because that's not the figure I want it to be. I was hoping it was going to come out to agree to my receivables ledger control, my payables ledger control account. So let's have a look now. Let's do that reconciliation. So the balance on my payables ledger control account from the previous slide we agreed was 31,293. But the balance on my 6 payables accounts is only 31,803. And that's a difference of 510. And this time, I don't have a figure that I can relate that to. There's not one singular transaction that instantly thinks that's the offending item. So if I was doing this as a job, I'd be going back to my day books, I'd be going back to my invoices. It can be quite a cumbersome task. Obviously, guys, in the exam, you're not going to have the luxury of that information. So we need to apply our knowledge. And I'll be honest and say, as students historically don't like this question. It's a question that they tend to panic over. It's probably a 2-3 mark question in the exam. So it's certainly not a question you're going to spend 30 to 40 minutes on. But that said, it's certainly a question you can secure the marks on. What we need to understand is what needs to happen to the balances. So either the balance on the payables ledger control account needs to increase, or the balance on the payables ledger needs to reduce. That's what needs to happen to get rid of that difference. So how this will be assessed in the exam is as follows. You'll be given some information like we've just gone through. You'll be given figures to calculate the payables ledger control balance. You'll be given information to calculate the balance on the payables ledger. We'll calculate the difference. So we know it's 510. We need to bear in mind what needs to happen, and that's the logical approach. Which account needs to increase, which account needs to reduce. And then we'll be presented with some options. And it's a process of elimination. We're going to go down these options. We're going to decide which of those satisfies what we need. So the first option says an invoice has been entered twice into the purchase day book. Well, remember, guys, that it's the day books that feed the control account. So if an invoice has gone in twice into the purchase day book, ultimately, if we remove that duplicate, it will reduce the payables ledger control. And we don't want that to happen. We need it to increase. So it can't be number 1. Discounts received was entered into the payables ledger control as a credit. Well, from our previous slides, we know that discounts received reduce the liability and therefore should go in as a debit. So if we take it out and pop it on the debit side to firstly correct the error, we then need to put it in again as a debit. That would reduce the payables ledger control account, and we don't want that. So it can't be option number 2. Number 3 states that a supplier account from the payables ledger was missed from the listing. Well, if that's the case, when we put the invoice in, when we put the account in, it would increase the payables ledger listing, and we don't want that. That will make the difference worse. It will make it bigger. So kind of by process of elimination, we're down to number 4, and let's hope this satisfies what we need. It says a supplier invoice was omitted from the purchase day book. Well, if it was, then the purchase day book balance would increase, the posting to the control account would increase, and that's exactly what we need to happen. So it really is a process of elimination. It's about understanding how the accounts behave and how the transactions behave. It's about understanding which account or which balance needs to increase and which balance needs to reduce. And then it's a process of elimination. The message from me, guys, when you get that question in the exam, that's a gift question. That's 3 marks you can easily secure with just a little bit of logic and taking your time. And that's it, really, from a payables ledger control account. So nothing radically different, no real new knowledge, but just the way it's assessed is different in this unit. I now want to spend a bit of time looking at the VAT control account. But before I do, guys, are you all okay? Are you all still with me? Any questions at all? Fab. That's great. Okay, so the VAT control account. Now, this is something that you would have had exposure to before. You would have certainly made your postings to the VAT control account. But it's going to be new in terms of how it's assessed in terms of this unit. So the VAT control account captures the VAT position of the business, and it establishes how much the business owes to HMRC, or indeed what the value of the refund is due. Earlier tonight, I said I can categorically say that the balance brought down on the receivables ledger control account will always be a debit, and the balance brought down on the payables ledger control account will always be a credit. But I can't say that with a VAT control. It's like that bank account. It could be either. So if you have a credit balance on the VAT control, it just means that you owe HMRC, you owe the VAT man. If you have a debit balance, it means that HMRC owe you. Okay? So in the question, you'll generally be told, okay, you may not necessarily be told it's a debit or a credit, but you'll be told it's a refund due or that there's an amount owing to HMRC, which means you'll use your knowledge to apply it. If for any reason you're not told anything about the VAT control account, you're just given a figure, then always assume the balance brought down is a credit. Because from a very simplified business model, the logistics of VAT in terms of collecting it on your sales, less the VAT on your purchases, in the majority of instances, it will always be a liability. And that's a very simplified way of looking at it. And we do look at VAT in a lot more detail as you progress to your studies, and we support you through your level 3 qual. But for now, let's just focus on this unit. So bear that in mind. And that looks incredibly busy. There's a lot going on in that control account. And by no means is that completely comprehensive. As I said earlier, as you progress to your studies, that account becomes busier and busier. But for the purpose of this unit, that will do you. So the VAT that you collect on your sales, that's not yours. You charge your customers VAT and you collect it from them, but ultimately that's payable to HMRC. And that's a liability to your business, and therefore will sit on the credit side of the VAT control account. But when we purchase goods and we pay VAT on those purchases, then HMRC allows us to reclaim that VAT. And therefore, that sits on the debit side of the VAT control to reduce ultimately what we have to pay. So in a very simplified manner, the VAT that is payable to HMRC is the VAT that we collect on our sales, less the VAT that we've paid on our purchases, with a few more transactions added in. Guys, probably for a lot of you there, that list will be new, and probably to start with, you may have to learn it as a list. As you do your work and you go through the study material on this, and as you look at some of the videos online, this will become more comfortable to you. But this probably, for some of you, if you're very new to this unit, this may be a little bit overwhelming because there's a lot of information there. So I'd certainly encourage you to take a picture of that, just something that you can refer back to. I'm not going to ask you to do any calculations on the VAT control account tonight because that would be a bit mean. But it is something just to bear in mind that going forward, as part of the unit, you will have to deal with some of these transactions. Not all, absolutely not all. It wouldn't be that busy in the exam. You wouldn't have that volume. But it's knowing which side of the account that the placement is on. And the problem is when we have the VAT control account, there's lots of transactions to consider because we're dealing with VAT on our purchases, on our returns, on our discount allowed and discount received. We're dealing with the VAT on our expenses. We're dealing with the VAT when we buy a new asset. What about when we pay HMRC? They pay us. So there's a lot to consider. And generally when we get this question, there'll be a lot going on in the question. So instantly we can become overwhelmed by the fact that we've got a lot of data here. And we're quite fortunate in as much as that some of the data is presented nicely, it's in tables, but we'll always be given that additional information to sort of contend with and make sure that we can pull out and extract what we need. And that's the trick. So the VAT from the sales day book is the VAT that you've collected from your customers on their sale. So that £5,940 will sit on the credit side of the VAT control account because that's payable to HMRC. The VAT that I've paid on my purchases of £3,300, that's reclaimable. And I'm going to pop that on the debit side of my VAT control to reduce what I owe HMRC, to reduce my liability. The discount allowed day book. So this is where I've sold goods to my credit customers. I've offered them a prompt payment discount. They've taken advantage of it, and therefore I can reduce my VAT liability by £88. I'm not going to collect that VAT for my customers, guys, because they paid me sooner than anticipated, and therefore I can reduce my liability. That will sit on the debit side of the VAT control. The VAT for my petty cash, it's reclaimable, it's an expense, it's going to sit on the debit side of my VAT control. The VAT for my purchase returns day book, well, that's going to sit on the credit side of the VAT control because ultimately I reduced my VAT liability by £3,300, and that's the figure from the purchase day book. For whatever reason, my suppliers have issued me with credit notes, faulty goods, damaged goods. I'm not going to pay that £100 in VAT to my suppliers, and therefore I can't reclaim it. So I need to credit the VAT control with that £100. And then I've got my additional information. And this is where you need to be careful of the wording of the questions. So equipment has been purchased and it amounts to £1,500. And it says that excludes VAT. So I clearly need to work out what the VAT is on that transaction, guys. It's £300. Okay, 20%. Admin expenses have been paid. Well, I can reclaim the VAT on that admin expense. And it's £1,500, but it includes VAT. So I'm not adding it on this time. I'm stripping it out. And again, when you're in that exam scenario, when you're a little bit nervous, it's so easy to think a question, it looks the same, it must be the same, I'll treat it the same. And that's where we lose marks. So just take your time because a subtle difference in the wording can make all the difference for the calculation. It's 250, the VAT figure. And the disposal of the non-current asset, it's 2,400. It includes VAT. I've sold an asset. I'm going to put that VAT on the credit side of the VAT control, and the VAT figure, it's 400. Just be careful if the figure includes or doesn't. And I'm told that at the start of the period, I owe 7,200 to HMRC. So that's a balance brought down as a credit. I have a liability, I owe them. Quite a few transactions there, guys. And excuse me, if you're not completely comfortable with all of them, that's okay, because it is new. Certainly in terms of how you've had to think about it tonight is new. It will take a little bit of time to get your head round. Excuse me, sorry. What I want to do now is just share with you how that VAT control account would look like. And if you're not quite sure, that's okay, because you have an opportunity to revisit this with a PowerPoint and have a look to make sure you are comfortable. And if any questions present themselves at the end, by all means shout up, or after you've reviewed them, if you need further clarification, my contact details are at the end of this PowerPoint. So that's how the VAT control account looks. So it's busy. There's a lot of transactions going on there. I haven't missed anything. It's the VAT figures from all of those tables I've taken. That's okay, Michelle. Thank you ever so much for joining us. So having mapped all my transactions in, guys, what I ultimately want to do is work out what the balance brought down is on the account. I do it in exactly the same as any other ledger account. I balance it off and I put my totals in. The balance carried down will obviously translate into a balance brought down. So it means I have a liability of £9,502. And that's what I owe HMRC. And that's all you're going to have to do. Yeah, there's no reconciliation to do in terms of this. It literally is, do you understand where transactions are placed? Do you understand why? And that will come. It may not necessarily be tonight, but that will come. Practice makes perfect. Review the PowerPoint, review the presentation, review the study material. There's some excellent resources available. And ask questions. Please don't be afraid to ask. So I was going to say I wanted to have a bit of fun, but I don't know whether fun's the right word at 6:30 on a Monday evening. But I want to just have a bit of a quiz. And again, if we don't know the answers to some of these questions, that's okay. But I'm just going to present you with a couple of terms, a couple of transactions, and all I want to know is, do you think they go on the debit or the credit side of the VAT control? Okay. D or C in the comments, guys. It doesn't matter if we don't get them right. We're here to learn. So the VAT on cash sales, what do you think? Is it the debit or is it the credit side? Fab. Lovely. Excellent. Thank you. What about the VAT from the discount received day book? That's a bit of a trickier one. We certainly know our VAT stuff. Well done. Excellent. What about the VAT on an irrecoverable debt? Well done. Certainly is. Absolutely. If you're not going to collect the VAT from your customers on the sale, you're certainly not expected to pay it to HMRC. There are specific rules about that, guys, in terms of the VAT relief on an irrecoverable debt. But for now, all we need to know is a debit. Absolutely right. Well done. The VAT on our sales returns day book. What do we think about that one? Absolutely well done. The VAT on our cash purchases. Doesn't matter whether it's a cash or a credit transaction, guys. It's the same. Perfect. That's great, guys. This really is great. The VAT from the purchase day book, I've kind of given that last one away, haven't I? Perfect. Lovely. The VAT from the discount allowed day book. What do we think about that? Excellent. Well done. Superb. And then the very last, but certainly not least, the VAT from the sales day book. Perfect. Okay, that's great. Well, really well done. To be honest, I'm really impressed with that. You clearly know your stuff on the VAT control account, so I don't envisage you'll have any issues with that at all. And guys, that kind of concludes the VAT control. And again, it is new content, so I'm not expecting you to be 100% comfortable with it. But are there any pressing questions before I move on? Lovely. Okay. If anything does present itself to you after and you think, oh, I never asked that, you'll have my contact details, and by all means get in touch. So the last thing I want to look at tonight is the wages and salaries transactions. So we need to be comfortable with some double entry here, and we also need to be comfortable with some calculations. And some of these terms, guys, you'll have come across just because of your own employment. But I want to just make sure, I don't want to leave that open to chance. I want to make sure you're absolutely okay. So our gross pay, this is that very attractive figure that we all instantly get offered the job at, and we all get our calculator, we divide by 12 and think that's the figure that we're going to take home. And sadly, it isn't. But the gross pay is generally what the job's advertised at. But before we can get too excited about that figure, we have to appreciate that there's certain items that have to be deducted. One of those is income tax, sometimes referred to as PAYE, pay as you earn. And this is a government tax, and it helps to provide funding for things like public services, so education, the NHS. The level of tax you pay depends on your income. And for those of you that are particularly interested on that, there is an optional unit at level 4, and that you can really delve into the depths of personal tax. So that's something I suppose to look forward to. Employers and employees' national insurance. So both parties have to contribute. And this contributes to your social security benefits. So things like your state pension, any statutory sick pay that you may be entitled to, maternity, paternity pay. That's what that sort of goes to help fund. Sometimes there'll be a student loan, and student loans are available. They're the HE student loans. And again, once your pay hits a certain threshold, unfortunately, that becomes repayable and it's deductible at source. You may, as an individual, have a particular course that's close to your heart, and your employer may provide the opportunity to deduct an amount for you direct into your charity. And depending upon your profession, guys, it may very well be that you pay into a trade union, and that may be something that is deducted at source. Terms there that we probably have an awareness of anyway, but I didn't want to leave that open to chance. So there's a difference between statutory and voluntary. Statutory is required by law. We don't have an option, guys. We have to. The government say. Voluntary is something we can opt in or opt out of. So I'm just going to go around those 7 terms, and all I want, and again, if you're not sure, please don't worry, but all I'd like you to put is an S or a V. Do you think it's a statutory payment? It means we have to, we've got no choice, or do you think it's a voluntary one, something we have a say in? So the first one I'd like us to consider is income tax. Is that an S? Is it statutory? It certainly is, yeah, absolutely. We don't have a choice on that one, guys. What about our trade union? Absolutely. Well done. What about the employee pension contributions? Do we have to, or can we opt in? Yeah, absolutely. I think the government would say they'd like us to, but it is voluntary. It's something that you can opt in or opt out of. Perfect. Well done. The employer and I, do they have to, or is that something they can opt? They can opt in it. No, absolutely, guys. It is statutory. What about the employer pension contributions? The employers have to offer a scheme, but their contribution is generally driven by whether the employee makes the payment. I've gone a little bit too far. What about the employee NI? Absolutely, yeah. We don't have a say on that one. And what about our student loan? Can we say no? No, unfortunately not. Okay, so well done. So those are our statutory and voluntary payments, not deductions, just payments. Yeah. We now need to understand the calculations which we need to perform. And there can be a variety of these, but these are the common ones that tend to crop up. So wages expense, how much does it cost the employer to employ their staff? And that's the gross wages plus all employer contributions. So employer NI, employer pension, if it's appropriate. That's the cost. It's not just the gross wages. That's the expense to the employer. It's the gross plus all employer contributions. The HMRC liability. What do we pay to HMRC? Well, we pay income tax, employee and employer NI, plus that student loan. The net wages. So this is ultimately what we take home, which I suppose is what we're all interested in. But this is the gross wages less all employee contributions. So things that we, the employee, have to pay. So that's our gross, less our employee NI and our employee pension, less our income tax, less the student loan, and less anything else, our trade union subs, our charitable donations. And they'll be given in the question. So our net wages is our gross, less all employee contributions. And then the last one, guys, probably the easiest. It's just the two contributions added together. Okay. And again, by all means, if you want to take a quick picture of that slide, you will be presented with it, and we're going to do the calculations together. So I'm not going to leave you on your own. But if you do want to take a quick picture of the slide, we are going to have a go at a couple of calculations now. Okay. So we've been given some information. It's quite a bit there. We've got gross wages, we've got income tax, we've got both the NIs, both the pensions, and we've got a student loan. And I want us to calculate those four headline figures. So what's the wages expense? It's the gross wages plus all employer contributions. So it's the employer NI and the employer pension. So guys, anyone brave enough to have a go at that figure? The gross wages plus the employer NI and the employer pension. What do we think? Excellent, well done. That is absolutely the right figure. What about our HMRC liability? So this is our income tax, the two NIs, and any student loan if it's relevant. So four figures: the income tax, the employer NI, the employee NI, and the student loan. What do we think, guys? What's that figure? Spot on, well done. Okay. And the net pay, and this is the one that there's a lot going on for. So this time, it's the gross wages less all employee deductions, or contributions, should we say. So it's the income tax, the employee NI, the employee pension, and the student loan. So it's the gross wages less the income tax, less the employee NI, less the employee pension, and less the student loan. So a lot to calculate there, guys, but I'll give you a moment to consider it. So the gross wages, less the employee NI, less the income tax, less the employee pension, less that student loan. That's sometimes an easy one to overlook, the loan is. And of course, it could have trade union subs in there if that was appropriate. Fabulous, guys. Well done. I'm very impressed. And the last but not least, probably the easiest one to calculate, just what do we pay to our pension fund? So it's both the employer and the employee together. So that's probably the easiest one for you to calculate this evening. Yeah, absolutely. You've got it. Well done. Perfect. So we've got the figures, and that's part of the assessment. Can we calculate them? Do we understand what goes into calculating those headline numbers? And the latter part of the assessment is going to be based on, can you do the double entry? Yeah, do you know your debits and your credits? And this hasn't been taught in any way, shape or form in terms of introduction to bookkeeping. This is completely new content for this unit. So I just wanted to share with you what that double entry was. The wages expense is capturing the cost to the employer of employing their staff. So I'm going to debit an account called wages expense, and I'm going to credit a wages control account. At this moment in time, no funds have exchanged, so that credit is almost capturing the liability the business has. What do I have to pay in terms of my payroll for the month, for example? I'm now going to record the liability I have to HMRC. So I'm going to debit the control, and I'm going to put that liability into the HMRC account, because that's ultimately where that money's got to go. So debit the control, credit HMRC to record that liability. And the net wages. And guys, if any of you have submitted any material for this already, you may have had a comment back from your tutor, because a really common error here is to credit an account called net wages. We don't have an account called net wages. The net wages represents the amount that the employer's paid you. That amount comes from the bank, so the credit goes through the bank, funds are leaving the business. We debit the control. If we made the payment, we no longer owe it. It's reducing that liability down. And lastly, the pension liability, guys. We're debiting the control. We're crediting the pension administrator. We're recording what we have to pay across to our pension administrator pot. The wages and salaries control account is kind of it is what it says on the tin. It's the control account which helps us manage the payroll transactions of the business. And you'll notice that in each of that double entry, the control account is featured. So half the double entry always passes through the control account, which actually makes learning the double entry a lot easier. Now let's take the figures that we've previously calculated plus the double entry, and let's just conclude the session by doing some T accounts. So my wages expense is £220,480. We all agreed that a minute ago. And I'm going to debit the wages expense account and credit the control account with that figure. The wages expense is made up of 3 items. It's the gross pay, the employer NI, and the employer pension. Okay. And sometimes, guys, you'll see that as one collective figure. Sometimes you'll be asked to post it individually. So if the question was to give you the gross pay, the NI, and the pension separately and asks you to post those values, you must post it as such. If it just says post wages expense, you can either itemize it or give it as a one figure. The net pay, again, we've calculated that. We all agreed it was 137,325. It's money leaving the business. So when that happens, I credit the bank and I debit the control account. So 2 lots of my double entries done. I've recorded the expense and I've recorded the net pay. The items in black text on the control account simply, guys, just illustrate the double entry that's just occurred. So I just hadn't got enough room on that one slide to show you it all. So that is the double entry from the previous slide. The HMRC liability, well, that records what I owe HMRC. It's the tax, it's the both NI contributions, and it's the student loan. So I'll credit the HMRC liability account. I'll credit the wages control. And I'm going to do that. I'm going to itemize it individually. Okay. And last but not least, I need to capture the liability that I have to my pension administrator. And I have both employee and employer contributions. There's a lot of information there, and that's a completely new concept. But the good news is, for this unit or for this activity, you can sanitize your numbers, and you can make sure, you can have confidence that you've done it right, because the wages control account should balance. There shouldn't be a balance carried down on this account. The debits and the credits should agree. And if you've done it right, they should agree on the £220,480. So, guys, humour me. Add up the debit side of the wages control account. And do you agree? Do they agree to £220,480? That's a few figures there to check. So the debits and the credits of the wages control, they should agree. They should both total on £220,480. Perfect. And I would always recommend you do that, because it's so easy when you're nervous for nerves to kick in. It's so easy to overlook a figure, to transpose a figure. There's not many things that we can say, well, you check this and you know you've secured the marks, but that's absolutely something you can do from the control account. The debits, the credits, they should agree. And guys, that's it from me this evening. I suppose the first thing to ask is, are there any questions that immediately have presented themselves to you? And I will just keep an... So when you record the HMRC liability, you credit the HMRC account and you will debit the wages control, because what you'll do is you're shifting where the liability is recorded. So you'll debit the control, you'll credit the HMRC account. Guys, your first port of call, obviously, you know, you've got a tutor that you're assigned to. By all means, if there's any questions, please contact them. But if there's anything relevant to this evening's session, that's my email address. You know, it'd be a pleasure to hear from you. And if there's any questions, I will gladly support. The next session is next Wednesday, slightly earlier time at 3 p.m. I hope you'll be able to join me for it. I think next week we're looking at journals, and we're looking at cash book and bank reconciliations. So I thoroughly hope you'll be able to join me for that session. If there's any questions, guys, please don't hesitate to get in touch. But for me, guys, thank you ever so much, and I look forward to being with you next week. Jenny, absolutely, yeah, you'll get a copy of the session and the PowerPoint, so absolutely in due course, yeah, of course you will. Okay, guys. The session next week will be recorded. Yeah, absolutely. Okay, that's brilliant. Thank you ever so much. Thank you, guys.